This summary is for developing strong investment habits increases your likelihood of making profitable decisions. Peter Sander, a financial writer, stresses the significance of value investing habits. Sander's guide is essential for new investors navigating today's complex investment landscape. Sander makes core value investing concepts and analytical methods easy for beginners to adopt. Peter Sander has authored several influential books on investing and personal finance, such as the 100 Best Stocks series, Value Investing for Dummies, and 101 Things Everyone Should Know About Economics. The author's background and expertise make them highly qualified to write on this topic. Developing good habits is essential for success in all areas of life. Whether it's exercising regularly, eating healthy, or practicing mindfulness, habits shape our daily routines and ultimately determine our long-term outcomes. To achieve success in investing, it is crucial to develop a thoughtful and habitual process. Developing a habit involves becoming consistent and comfortable with a familiar activity that brings pleasure. These habits are designed for long-term investing, typically lasting 5 to 7 years. They aim to generate cash, achieve above-average appreciation, and promote risk-averse growth, in line with the principles of the value school of investing. Value school investors, inspired by Benjamin Graham, evaluate a business's intrinsic value and compare it to its share price before making investment decisions. Discovering and cultivating your unique style is a crucial aspect of personal growth and self-expression. Tailor your investments to align with your specific financial goals, risk tolerance, budget, timeframes, and experience. In this program, you will gain expertise in financial tools and analytics that can positively influence your habits. Begin by developing a deep understanding of your investment goals and your personal risk tolerance. To grasp the distinction between investing and trading, reflect on your own experiences. Have you ever taken risks for big rewards? What would your response be to a 15% or 25% decline in your portfolio over the course of a year? Calculating the numbers. Discover the essential concepts of investment math, such as present and future value of investments and the significance of compounded interest. For example, if you invest $100,000 at a 6% interest rate for 10 years, you will have $179,085. In comparison, if you invest at a 5% rate, which is the historical market rate of return, you will have $162,889 over the same time period. A 1% rate of return can have a significant impact over a decade. To determine the time period or rate of return required to double your money, you can utilize the rule of 72. To double your money, divide 72 by the return rate to find the number of years needed for investment. At a 12% interest rate, your money will double in 6 years. A lower rate of return results in a longer duration. Dividing 72 by the number of years will accurately determine the return rate. These figures are based on reinvesting at a compound interest rate that may vary over time. Choosing individual stocks can be a profitable investment strategy. Discover trustworthy sources for financial information. Discover the distinctions between company and market news, encompassing industry and economic trends. Diversify your investments through asset allocation, to build a portfolio with a variety of companies, industries, time horizons, instruments, and risk levels. Build your portfolio with a focus on short-term opportunities. Reduce the number of actively managed investments in your long-term portfolio. Learn essential habits for stock buying. Base your decisions on fundamental equity analysis theory, which means that when you purchase a stock, you are essentially purchasing a company. Conduct a thorough analysis of the price and key financial factors. Gain a comprehensive understanding of the business. Consider management, brand appeal, financials, and logistics. You can argue that good investing is a matter of skill, experience, foresight, time, energy, and a fair dose of luck. When purchasing a stock, it is important to consider the enterprise's ongoing commercial activities since you are essentially acquiring the entire firm. Imagine yourself as the company owner. Acquire comprehensive knowledge about all operational aspects. This will assist you in identifying its sustainable advantage in the marketplace and determining if it is based on costs, customer loyalty, or production or market segment opportunities. Company websites and public documents are reliable sources of information. Gain a comprehensive understanding of a stock's strategic and financial fundamentals, including its assets, liabilities, revenues, expenses, and how they are interconnected. Monitor these key metrics to gain insights into the company's past performance and future trajectory. Intangibles. Factors like brand strength, innovation, customer loyalty, market share, and effective management are also important for generating profits. These elements are crucial indicators of future success, competitive advantage, and market position. In fact, stock market investing returns have outperformed the economy as a whole over the long haul, but not by as much as the numbers might suggest. Top brands dominate their industries. Their exceptional customer service allows them to command higher prices without losing customers. Innovation, quality, and supply chain management are important intangibles. Leadership is crucial, yet challenging for outsiders to understand. Seek transparency. Are corporate messages written in clear and simple language? Examine management compensation and executive perks to gauge executives' commitment to shareholder interests. Companies that fund star products with cash cow cash, like drug makers and, in the old days, HP, are usually a good bet, if they're using their cash wisely. Key fundamentals to consider are profit margins, cash flows, expense trends, debt burdens, and working capital. Working capital is calculated by adding cash, receivables, and inventory, and then subtracting short-term debt. Cash and earnings are two important financial metrics that provide insights into a company's financial health. While cash refers to the actual money a company has on hand, earnings represent the profits generated by the company. Both metrics are crucial. Earnings and cash flows should align over time. This is reflected in the company's financial statements. Analyze the relationship between long-term debt and growth rates to determine if a company is expanding without excessive borrowing. Niche players are highly specialized and focused companies that excel in serving specific market segments. Marketing distinctions are particularly impactful for niche players like Starbucks or Apple, who successfully established new markets for their products. Look for companies with unique products in growing markets. The Boston Consulting Group developed the Growth Share Matrix in 1970 to categorize products based on their growth and market share. This analysis classifies products based on their sales volume and growth compared to their market share. While quantifying some factors may be challenging, this exercise offers a valuable overview of a firm's product direction. SWOT. To predict a company's future direction, analyze its marketing capabilities and initiatives. Please analyze the market rank, product positioning, and pricing. Use the SWOT analysis to evaluate a company's strengths, weaknesses, opportunities, and threats on a 4-box grid. Use each quadrant to assess a company's strengths and weaknesses. Diversification is essential for prudent investors. They achieve this by investing in various stocks or funds across different industries. To gain a comprehensive understanding of a company, put yourself in the shoes of a customer. Assess their advertising, online and physical presence, customer service, and the ease of using their products. Consider if any customer education is necessary. A physical inspection of a firm's outlets can reveal important insights such as long lines at the registers, empty stores, or shoppers leaving without making a purchase. Understanding intangible concepts requires absorbing, interpreting, and experiencing them, rather than simply reading a list of facts. Determining management's focus can be difficult. Are they driven by power and compensation or by delivering results and value to shareholders? Evaluate the success of top managers and their teams in creating value for shareholders and customers. Apple's Steve Jobs prioritized customer needs over titles and corporate jets. Investor value is crucial for success. To understand how top managers address investor concerns, assess their leadership and administrative qualities. Does the company have a strong corporate vision, positive culture, high-quality products, honest public messages, and consistent brand promises? Does it have a customer service focus? An investment advisor should be an excellent partner, someone you would hire for a partnership in the investing business. Investors should determine if a firm provides value or wastes assets. Value can be financial, such as when margins and capital grow faster than expenses and debt. Is the firm a leader in the market? Is there a strong brand and category presence? Does it showcase innovation and effective management? A company's value declines when its margins and market share decrease, costs rise as cash levels drop, and financial results become inconsistent over consecutive quarters. Blurred strategy and misfit acquisitions can lead to a decline in value. Advantages and disadvantages. When considering a stock purchase, it's helpful to make a list of 3 advantages and 3 disadvantages for a straightforward comparison. Studies have shown that individuals can effectively grasp and process a limited range of 3 to 7 new concepts at once. Utilize this formula for comprehensive analysis of balance sheets, product portfolios, and management. To successfully acquire and own a business, it's crucial to thoroughly understand its financials and key drivers of success. The analysis helps you make informed decisions about buying stocks. The answer depends on the best price for a specific stock. Business valuation is a necessary and structured process. Calculate your cash inflow from owning the stock. The company generates returns for its shareholders through dividends, share repurchases, or potential sale. Consider the timing of cash receipt during a sale or repurchase, as receiving payment now is more valuable than receiving it in 1 year. Many investors fail to thoroughly learn and understand their business. Use the price-to-earnings ratio, PE, to evaluate a stock's price. The price-to-earnings ratio is calculated by dividing the current stock price by its earnings per share from the past year. Forward PE ratios project future price-to-earnings ratios for the next year. The earnings yield or effective yield is a valuable ratio that serves as the opposite of PE. Other widely used financial ratios include price-to-book, price-to-earnings to growth, price-to-cash flow, and price-to-sales. After conducting thorough research on these ratios, it is advisable to aim for an entry price that is lower than the calculated values. This provides a margin of safety to purchase the stock at a lower price in case your projections are overly optimistic. Please take into consideration the funds. You have the option to select from a variety of funds, such as mutual funds or exchange-traded funds, ETFs, which are managed by professionals and focus on specific market sectors, indexes, or strategies. Funds are investment packages with pros and cons. Some drawbacks to consider are fees, loss of control, and a tendency towards average performance. The benefits include professional management, favorable taxation, and diversification. Smart diversification involves reducing risk without sacrificing returns. There are over 1,300 ETFs and 10,000 mutual funds available today, each with significant differences. ETFs offer greater transparency and cost-effectiveness, although they can sometimes become complex due to the underlying indexes. Choose mutual funds that have reasonable costs and ensure they align with your investment goals. Achieving stock market success. Before buying a stock, it's important to observe its price movement over time, considering that you may hold onto the stocks for an extended period. Assess if the price is currently trending upwards in the short term, potentially offering a more favorable buying opportunity when it eventually declines. After purchasing a stock, have confidence in your research and continue to hold or increase your position over time. What motivates your investment decisions? To generate income, naturally. Achieve, maintain, and expand, that's the essence of it all. Your perspective might evolve as you observe the stock, witness changes in management, revisions in quarterly financial estimates, and more assertive actions from its competitors. Review the company's financial reports, press releases, and participate in stockholder conference calls. Be cautious when these sources share negative news or discuss major changes. Successful investors possess a well-rounded perspective on their endeavors. Options play a crucial role in investing, based on an investor's knowledge and risk tolerance. Buying call options allows investors to profit when the price of the underlying equity increases and the value of the call option surpasses the strike price. Investors can profit from a declining stock by purchasing a put option and benefiting from a decrease in the option price below the strike price. Experienced investors can earn cash through covered call writing. This strategy entails selling options on your shares. If the stock price stays below the strike price, the investor receives the premium. Investing requires diligent effort, despite common misconceptions. Stocks generate cash through dividends. In 2013, dividends averaged 2% to 4%. While dividends are not guaranteed, you can access investment information such as lists of high-paying stocks or ETFs. Developing good buying and decision-making habits requires discipline when it comes to selling stocks or fund investments. Sell when there is a superior investment opportunity, even if it means selling your current position and holding cash. A smart selling strategy is to sell half. Diversifying your stock portfolio helps mitigate risk and allows for potential gains from price increases. Evaluate your outcomes by utilizing SWOT analyses for your portfolio.